Hello friends, welcome back to Investment Professor. In today's video, I'll be walking you through 4 simple yet powerful trading strategies that are easy to learn and can generate consistent profits. These strategies have been rigorously back-tested, ensuring a high win rate so you can trust in their reliability. The best part is that I've laid out clear, step-by-step instructions for each one, so you can start implementing these strategies in your own trading right away. Whether you're a beginner or an experienced trader, by the end of this video, you'll be ready to put these methods into action and see results. So without further ado, let's dive into the first strategy. Strategy 1. Capitalizing on stop hunts. The first strategy revolves around a market phenomenon called a stop hunt. For those of you who may be unfamiliar with this term, a stop hunt occurs when larger market players, like institutions, deliberately push the price beyond obvious support or resistance levels. This forces smaller traders who have placed their stop-loss orders around these levels out of their positions. While this may seem frustrating for the average trader, with the right strategy, you can actually turn this situation into a profitable opportunity. Here's how you can trade a stop hunt. Identify an obvious key level. Start by locating a clear and well-defined support or resistance level on your chart. These levels are crucial because they attract the attention of many retail traders, making them prime targets for stop hunts. The more obvious the level, the better, as it increases the likelihood of institutional activity around that area. Wait for a break of the key level. Once you've identified your key level, patiently wait for the price to approach it and break through. This could be either a break above resistance or a break below support. At this point, zoom in on a lower time frame. For example, if you're on the 4-hour chart, switch to the 1-hour or 30-minute chart to closely analyze the price action and look for signs of a stop hunt versus a true breakout. Set limit orders for both directions. Instead of predicting whether the price will reverse or continue in the breakout direction, you can prepare for both possibilities. Place a limit sell order just below the key level to catch the reversal if the price breaks through and then comes back down. At the same time, place a limit buy order just above the key level in case the breakout is genuine and the price continues to rise. This way, no matter which direction the market takes, you're positioned to capture a profit. 4. Risk management. Once either your buy or sell order is triggered, make sure to place a stop loss to protect your position and a profit target at a reasonable distance. For example, if your sell order gets triggered after a stop hunt, place your stop loss slightly above the breakout candle and set your take profit target at 4 times your stop loss distance to maximize your risk to reward ratio. This is crucial because, while this strategy is designed to take advantage of stop hunts, the market can still move unpredictably. This strategy is a great way to turn what many traders see as a frustrating event into a potential profit. Now let's move on to the second strategy. Strategy 2. Fibonacci retracement with a twist. The second strategy involves using the Fibonacci retracement tool, but in a way that's slightly different from the conventional method. The Fibonacci tool is widely used to help traders identify where a retracement might end, making it easier to time entries in trending markets. Here's how this strategy works. 1. Identify a trend with a retracement. First, look for a clear trend where the price is moving either upward or downward, and then begins to retrace, pull back from the trend's high or low. The idea is to enter the trade when the price completes its retracement and resumes moving in the direction of the trend. 2. Apply the Fibonacci retracement tool. Once you've spotted a trend with a retracement, use the Fibonacci tool to draw from the swing low to the swing high, in the case of an uptrend, or from the swing high to the swing low in a downtrend. What we're particularly interested in here are the 0.618 retracement level and the 1.618 extension level. 3. Focus on the 0.618 level. The 0.618 Fibonacci level is a key level where the price often reverses after a retracement. When the price approaches this level, it's time to zoom in on a lower time frame to analyze the price action more closely. Look for signs of rejection at this level, such as candlestick patterns or momentum indicators like the MACD crossing upwards, which suggests that the price is likely to bounce. 4. Enter the trade and set your profit target. If you see confirmation of rejection at the 0.618 level, enter a buy or sell position, depending on the trend. To set your profit target, use the Fibonacci tool again and aim for the 1.618 extension level. This gives you a clear and objective exit point for the trade. Additionally, place your stop loss just below the 0.618 level to protect your capital in case the trade doesn't go as expected. By focusing on these specific Fibonacci levels and using them to time both entries and exits, you can increase your chances of catching high probability setups in trending markets. Strategy 3. Scalping with CCI divergence. The third strategy is a scalping technique designed for traders who prefer short-term trades on smaller timeframes, like the 1-minute chart. This method uses the Commodity Channel Index (CCI) indicator to identify divergences, which can signal potential reversals in price. Here's how you can execute this strategy. 1. Add the CCI indicator to your chart. To start, apply the CCI indicator to your chart. The CCI helps you identify overbought or oversold conditions, but for this strategy, we'll focus on its ability to spot divergences. Divergences occur when the price is moving in one direction, but the CCI indicator is moving in the opposite direction, signaling a potential reversal. 2. Look for divergences. A bullish divergence occurs when the price is forming lower lows, but the CCI is forming higher lows. This indicates that the downward momentum is weakening and the price may reverse to the upside. A bearish divergence occurs when the price is forming higher highs, but the CCI is forming lower highs, signaling a potential reversal to the downside. 3. Enter the trade. Once you've identified a divergence, enter a trade in the opposite direction of the current price movement. For example, if you spot a bullish divergence, price forming lower lows but CCI forming higher lows, enter a buy position. Conversely, for a bearish divergence, enter a sell position. 4. Set tight stop losses and profit targets. Since this is a scalping strategy, the goal is to capture quick, small profits. Set your stop loss just beyond the recent low or high and aim for a take-profit target at a nearby support or resistance level. You'll want to repeat this strategy multiple times to accumulate small wins throughout the trading session. Scalping with the CCI indicator is a great way to take advantage of short-term market fluctuations, especially in volatile conditions. Strategy 4. Trading range markets with the midline. The final strategy is designed for markets that are moving sideways or within a range. Markets only trend about 30% of the time, meaning they spend the other 70% moving within a defined range. Knowing how to trade in these conditions can unlock many profitable opportunities. Here's how you can trade range markets. 1. Identify a range market. The first step is to find a market that is moving sideways, where the price is oscillating between a clear support level at the bottom and a resistance level at the top. This is known as a range-bound market. 2. Draw a midline. Once you've identified the range, draw a horizontal line exactly in the middle of the support and resistance levels. This is called the midline, and it helps you divide the range into two zones: the upper zone between the resistance and the midline, and the lower zone between the support and the midline. 3. Analyze the price action around the midline. When the price is in the upper zone and approaches the midline, watch for signs of whether the price will bounce off the midline and head back toward resistance, or break through the midline and move toward support. A strong rejection of the midline, e.g. long wicks or a bullish reversal candlestick pattern, suggests that the price is likely to remain in the upper zone, providing an opportunity to enter a buy position. 4. Enter the trade and manage risk. If the price rejects the midline and begins moving back toward the upper zone, enter a buy position and set your take-profit target at the resistance level. Conversely, if the price breaks below the midline with strong momentum, it's likely to head toward the support level, giving you an opportunity for a sell trade. Always set a stop loss just beyond the midline to protect your trade. By mastering this strategy, you can take advantage of range-bound markets, which occur frequently and provide plenty of trading opportunities. These 4 strategies cover a wide range of market conditions and can be applied whether you're a beginner or a more experienced trader. By focusing on clear, actionable steps and prioritizing risk management, you'll be well on your way to improving your trading results. Thanks for sticking with me throughout this video. Now it's time to put what you have learned into action. Take notes, learn from it, and succeed. Let's grow together. Drop your questions or thoughts in the comments below. Thanks for watching, and I'll see you in the next video.